Hey, in this video, I will be covering some of the best index funds / ETFs that money can buy this year in 2022. I'll be covering from low expense ratios, basically free, all the way to some of the best performing funds over the years. My list includes index funds from a variety of different companies, tracking broadly diversified indexes, as well as some of the lowest cost funds trading on the public markets. One of the most important factors in your total return is cost, which is why I included funds with some of the most affordable expense ratios on this list. For number 3 on my list, we have Fidelity's Zero Large Cap Index, FNILX. This fund holds stocks that are included in Fidelity's Large Fund Index. Its purpose is to mirror the total return of large cap companies in the United States. Large cap companies can make a great investment because they are well established and have been able to provide consistent growth through long periods of time. This Fidelity fund has no expense ratio, hence the zero within the index fund's name. Comparing the top 10 holdings of FNLIX and the S&P 500, these two funds are practically identical. The Fidelity fund does not technically track the S&P 500, it actually follows the US large cap index, but the difference between the two is minimal. Fidelity strategically does this to not have to pay a licensing fee for the S&P name, keeping costs lower for you, the investor. And speaking of costs, like I stated, this fund has an expense ratio of 0%, meaning that for every $10,000 invested, it would cost you $0 annually. If you invested $10,000 in this fund since its inception in 2018, the current value of your investment today would be worth over $16,000. Keep in mind that this fund is not very well diversified. Stock markets are extremely volatile and can decline significantly in response to political issues, regulatory issues, or economic developments. With this fund, you will only be invested in the largest companies in the United States, meaning you will have no exposure to foreign markets, small cap companies, or different asset classes. Even though this is a great fund, I wouldn't recommend to go 100% all into this fund since you are only limited to being invested into large cap stocks. This brings us to number 2, which is the Russell Vanguard 2000 ETF. This fund tracks the Russell 2000 Index, which is a fund that holds about 2,000 of the smallest publicly traded companies in the United States. Unlike the last fund that we spoke about, which was FNLIX, that only holds large cap companies, the Vanguard Russell 2000 ETF focuses more on small cap companies. A large cap company has a market cap of $10 billion or more, and a small cap company has a market cap of $2 billion or less. Tons of these small cap companies are companies that you've probably never heard of before. Looking at their top 10 holdings, we have Intellia Therapeutics Inc., Star Surgical Co., and Lattice Semiconductor Corp. My point proven, you've probably never heard of any of these small cap companies. A fund that tracks small cap companies can present huge opportunity that cannot be found in large cap stocks like Amazon, Google, or Apple. Imagine investing in Apple shares back when they were trading under 10 cents per share. The downside of this is that it only invests in small cap companies. Small cap companies tend to be more volatile because they do not have the consistent growth that large cap companies do because, well, they're small companies and they haven't been around for as long of a time as large cap stocks have. Volatility in small cap companies tends to be higher. It's not abnormal to get a little seasick when stock prices begin to change rapidly. There is also limited liquidity. Liquidity is how easily you're able to buy and sell shares of a particular security. This isn't financial advice, but here's what I personally would do. It would probably be a smart idea to combine this small cap fund with a fund similar to Fidelity's Zero Large Cap Index. This way, owning various large cap stocks with a mix of small caps gives you broader exposure to the overall market. This ETF started trading in 2010, and it is a Vanguard fund, which is great because Vanguard likes to keep costs low for their investors. This fund has an expense ratio of 0.10%. That means every $10,000 invested would cost $10 annually. Very affordable. $10,000 invested in this fund since its inception would be worth about $33,000 in today's value, having experienced a 231% gain over the past 12 years. Not bad. For number 1, we have Fidelity's International Index Fund. This fund tracks the MSCI EAFE index and seeks to provide investment results that correspond to the total return of foreign and emerging stock markets. FSPSX holds large and mid-cap stocks from 21 overseas developed markets and weights them by market capitalization. It holds more than 900 stocks and has only 14% of assets in its 10 largest names. Over the last 10 years, this fund has returned an average of 8.21%, meaning that $10,000 invested back in 2012 would be worth around $18,210 today. This fund only holds stocks of companies which are outside of the US, which is great if you want to add diversity of foreign stocks into your portfolio. Some of this fund's most notable holdings are Nestle, Moet Hennessy, Louis Vuitton, and Toyota. Even though an 8.2% return on average may seem great, it's not the highest return on this list. The goal with this index is not to get the highest return, but more so on adding broader market exposure and diversity to your current holdings. This fund has an expense ratio of 0.04%, which means you will only pay $4 for every $10,000 you have invested in this fund, making it extremely affordable. Since this fund holds stocks in foreign and emerging markets, there can surely be higher volatility and tons of uncertainty when it comes to issues such as foreign tax policies, foreign developments, and political issues. I know these things tend to happen in the US all the time, but foreign markets seem to have more volatility when issues arise. Just some things to consider before you go out and pour all of your money into this fund. You don't necessarily have to invest into these particular funds. A mixture of funds similar to these can help you get more exposure to the overall market and have all your boxes checked in terms of diversification. That's basically it. Hey, thanks for watching this video, and I'll see you guys in the next one. Peace.